Imagine you could draw a single line on a chart that shows the true average price everyone actually paid for a stock, not just a simple average of the candles, but one that respects how many shares changed hands at each level. That line exists, the big institutions live by it, and today we learn it. The VWAP and its powerful cousin, the Anchored VWAP. Let's decode the name first. VWAP stands for volume-weighted average price. The crucial word is weighted. A normal moving average treats every day equally, but the VWAP does not. It weighs each price by the volume that traded there. A price where millions of shares changed hands counts heavily. A price where almost nothing traded barely counts at all. The result is the true center of gravity of all the trading. So why should you care about this particular line? Because the giants care about it. When a huge fund needs to buy 1 million shares, its traders are judged against the VWAP. If they bought below the day's VWAP, they got a good price, better than average. If they paid above it, they did a poor job. This means that the VWAP is not just a line on your screen. It is the benchmark that moves real, enormous money. And lines that big players watch tend to matter. Now, how do you read it? The logic is beautifully simple. When the price is trading above the VWAP, buyers are in control, and the stock is, by definition, expensive relative to the day's fair value. When the price is below the VWAP, sellers are in control, and the stock is cheap relative to that fair value. The line acts like a center of balance, and price is constantly pulled back toward it, then pushed away. This makes the VWAP a natural intraday support and resistance. In a strong up day, the price will often pull back down to the VWAP line and bounce, as institutional buyers step in right at their benchmark. In a weak down day, rallies tend to fail right at the VWAP for below. Day traders watch that single line obsessively to decide whether the buyers or the sellers are winning at any moment. But here is the big limitation you must understand. The classic VWAP resets every single day. It starts fresh at each market open and is calculated only from that day's trading. That makes it a powerful intraday tool, but useless for anything longer. It cannot tell you the average price over the last 3 months, because every morning it wipes the slate clean and starts over. And that limitation is exactly what the Anchored VWAP was invented to solve. The Anchored VWAP, or AVWAP, does the same volume-weighted calculation, but instead of always starting at the day's open, you get to choose the starting point. You drop an anchor on any meaningful moment in history, and it calculates the true average price paid by everyone from that moment until now. Think about how powerful that is. Anchor it to the day a company reported earnings, and the line shows you the average price every single buyer has paid since that report. Anchor it to a major market top, and it reveals the average cost of everyone who bought into the hype. Anchor it to a crash low, or an IPO day, and you see the average entry of that entire era. The anchor turns a one-day tool into a long memory map of where real money got in. And those anchored lines become remarkably strong levels of support and resistance. Why? Because they represent the break-even point for a whole population of traders. As price falls back toward the average price everyone paid since the earnings, all those buyers who are now barely in profit get nervous and defensive, and that emotional crowd often turns the price right there. The AVWAP marks the line in the sand for an entire group. So in practice, a day trader leans on the regular VWAP to navigate a single session, while swing trader or investor drops an anchored VWAP on the last earnings or the last major low to judge the bigger picture. Same engine, volume-weighted average price, but the anchor lets you ask a much richer question: the average paid since when? Now, the honest caveats, as ever. The VWAP is fundamentally a short-term and intraday tool, far more useful to active traders than to long-term investors. Like every indicator, it is built from past data, so it describes where money has been, not where it is going. And You already know the ending. The person quietly buying a broad index fund every month needs none of this because they are not benchmarking fills or hunting intraday levels at all. So look again at that one clever line. You now know the VWAP is the volume-weighted average price, the true center of gravity that the institutions are measured against, where above is expensive and below is cheap. And you know its upgrade, the Anchored VWAP, which you pin to any key event to reveal the real average price paid ever since. One is the heartbeat of the day. The other is the memory of an era. I'll see you in the next one where we talk about the Golden Cross. Until then, keep it simple and respect the line the Giants watch.